Hi guys, this is Mark Shawson, the Pattern Trader. Recently, Georges posted this review on our website. He was good enough to leave the review, so I'm just going to give a shout out to Georges. Georges says, very good teaching. I learned a lot, and it pays to regularly listen at the explanations given by Mark. Slowly but surely, one's reflexes in analyzing the markets do improve. So thanks for that comment, George. Now, I'm just posting this video ahead of the July 4th weekend. I want to wish everybody in the United States a happy 4th of July, and around the world extend to you healthy, best wishes wherever you are managing through this ongoing health crisis. But with that said, as I look forward into the July-August timeframe, especially as it pertains to the FX pairs, usually we see pretty range-bound trading markets, but this doesn't mean that there are no opportunities or you can't find a way to make money during these kind of stealth markets. What I tend to do is look at the major trends, understand from a global view, from a long-term view, where certain pairs are headed, and then during these periods of gestation where, I don't look for prices to break out one way or another. I look for opportunities to build positions. And in a moment, I'm going to go to the real-time charts and show you what I'm looking at, how I kind of take a step back, see where a certain pair is taking a directional bias. And then I look to establish nibbles, take little bites and build positions in these pairs as I anticipate that eventually they will break in my direction, even if it takes a couple weeks or even if it takes a couple of months. What I'm trying to do is take a bite size here, and then if it rallies and I'm looking to go short, I'm not worried about it, losing against the initial position. I'm actually going to add to my position. And so I might start with, 0.25% of my account balance as a risk position. Then if it rallies, I'll take another bite-sized position and take another 0.5%, and on until I built a position that maybe represents 2% of my account value in anticipation that eventually it will break. Now, two of the pairs that I'm looking at, ironically both on the short side, is the euro versus the New Zealand dollar, and the pound versus the Swiss franc. And now I'm going to go to live charts, show you what I'm looking at, a global view, and then look, and show you how I look to amalgamate a position and then hold it. And I'm not, afraid if it goes a little bit against me during this period or if it goes nowhere. Eventually, when these things break in my favor, that's when, I'll make money. So that's kind of my mindset as I go into the summer. It's not to say that I'm not going to find a pair here and there that's going to break out one way or another, but it's not my expectations. And what I'm trying to do is build positions in anticipations of the breakouts in my favor. Now I'm going to give you an understanding of what my thinking is when I'm looking to build a position over the summer, or frankly at any time. But frankly, over the July-August timeframe, where FX pairs can get pretty range-bound and we can get pretty confused about where things are headed, what I try and do is look for a pair that I really understand what the governing trends are, what the governing price patterns are, what the governing price action is. And once I really have no ambiguity, then I have also no problem in building a position. So let me try and give you an insight into my thinking. In this chart, I'm looking at the long-term chart of the British pound versus the Swiss franc. This is a monthly chart, which means that every one of these price bars is 1 month in time. And you can see that unambiguously, this trading pair has been in a long-term secular or primary downtrend. From 13 years ago at a price level of 250, we're now trading at less than half that, at 120 or about 118 in the British pound versus the Swiss franc. So we are in a clear downtrend. Now, some might say, isn't this a double bottom where we have two kind of stabs at this lower area and it looks like there may be some support? And to my mind, when I see a double bottom, what it should mean is that if it is a bottom, that we should see a continuum of higher highs and also higher lows. And instead, what we have here is a continuum of lower highs and also lower lows. And so, to my mind, there is nothing to suggest that there is anything in front of this freight train that is going lower. And so, to my mind, this pair is going to keep going low. So now that I'm fairly confident that the breakout is going to continue to the downside in pound versus Swiss franc, I want to start building a position on the short side. The only danger of the pound versus the Swiss franc is that you can see that this pair has a propensity to go into long-term trading ranges. So that is the danger, that it just could go sideways for a continued period of time. So with that said, what I'm trying to do is build a position, get a stake, and actually build a position on rallies. So if this thing rallies, I'm actually going to sell into it, as I'm absolutely confident eventually this thing is going to go lower. So I'm looking at the current boundaries right now. You can see that recently we had what I call a key reversal, where the market made a new high and then closed on the low of the month. And you can see when it did so here, where it made a new high, closed on the low, it just indicated that and pointed in the direction where prices were going to head. So I see that the market is bounded on the upside by these key reversals around the 122. And then on the other hand, we have the support right around the 111, 112 area. So now I have an established boundary. On the high side, I do not see prices going above this 122, which means that if we're trading at 118 right now, if this thing starts sneaking a little bit higher, I'm going to start looking to sell into those rallies. And what you may want to do is get an initial position at or near current levels. You can take a position, a very bite-sized position representing 0.25% of your overall equity, and then build a position over time. And I'm going to show you how to do that using the position size calculator in just a moment. Now I'm looking at the British pound versus the Swiss franc on a weekly chart, which means each one of these price bars represents 1 week in time. And also on the weekly graphic, you can see that we have been going steadily lower. Now in the shorter time frame, this weekly chart, you can see that we had a series of thrusts to this 135 area, which represented formidable resistance in the pound versus the Swiss franc. And that recently this pair thrusts below the neckline. A neckline is simply a line that joins the entire pattern, and then we had a retest of this neckline around the 122 area, and you can see that it was thrust back in the direction of the trend. And so I am looking for prices to basically perhaps go in this level, but ultimately break lower, which means that I want to be holding a short position and building a position. So that means that even if prices go higher in the short term, I'm actually going to be adding to my short position on a rally. Now this is something that I typically don't advise, where you short against the trend, but since the major trend is lower, if you get a slight hike back up to the 119, 120 area, to my mind, that would just be a fertile opportunity in this primary downtrend. And I would, again, just look to put your stop somewhere above this 122. So I would look for any breach of that price level around the 122 as a breach of this mini downtrend, if you would, so that you can start building a position. And even if it goes against you, it won't represent a huge risk. But on the other hand, I think you've got a huge upside, not if, but when this thing breaks below the 110 price level. So now I'm going to show you how you can build a position, even accepting that there may be several hundred pips risk to the upside. So I'm looking at what's called a position size calculator, which is going to tell you exactly how big a position you need for a given risk. I'm going to put the link alongside this video so you don't have to worry about doing that. And the way this position size calculator works, you can basically use any major currency around the world, wherever you are. For the sake of this demonstration, I'm going to assume a US dollar. I'm going to assume account size of, let's say, $5,000. And I'm going to assume an initial risk ratio of 0.25. So remember our parameters. Sorry, before using the risk calculator, I just want to reinforce what I'm looking at. And I'm looking at the British pound versus the Swiss franc on the daily chart. And you can see on the daily chart, this is the double top that I'm looking at that, to my mind, will ultimately govern the direction of prices lower. But I don't rule out the fact that you could have prices sneak back perhaps all the way to the top end of the trading range. But this is my risk, which is currently about 400 pips away from where we are right now, which should not intimidate you. So I just wanted to kind of reinforce what the parameters were at the moment. Pound versus Swiss francs trading around 118. The high end of this thing's around 122.50. And so even if you want to sneak in a position here that represents 0.25% of your portfolio, accounting for this risk, you can do so. And then as pound Swiss rallies, or if it rallies, you can add to your position and build this position. So I'm going to go back to the calculator and just use these parameters that we've been looking at. So with pound Swiss trading around 118 and the stop loss being around 122, you're looking at a 400 pip stop loss. But again, people get very intimidated by saying, I can't use a 400 pip stop loss. And again, we're going to relate it to being 0.25% value of your account. And so we would effectively drop down, find the pound Swiss, hit the calculate button. Sorry, you have to express it at 0.25 to express your risk as 0.25% of your overall account. And you'll see, even with a 400 pip risk, if you got stopped out, you would only lose $12.50 of your $5,000 account, which represents 0.25%. Now, what I would do is when this, or if this rallies, let's say it goes from 118 to 119, and you want to add a further position, build your position. So then the next position you would build at 0.5%, and then you would have a 300 pip risk. You'd hit the calculate button. This would be your position size, and this would be your risk. And then if it rallied another 100 pips, and you wanted to add to your position and stay at 0.5%, so now you've got about 1% risk of your account. Now you have 200 pips stop loss as it rallies. You basically have that size, and so you would eventually have something that represents about a 2% risk to your account. And let's say it blew through that 122 level, you'd risk $100 of your $5,000 account if you risk 2%. But if you start building a position around the 118 to 120, so just to reinforce this idea on the daily chart, let's say you started off with a bite-sized position right here, 0.025% of your account. Then if it rallied another 100 pips, you add a position that represents 0.50 or 0.5%. And then let's say it gets back up to 121, and you add another 0.5% right here. And let's say it rallies up here, and then it eventually crashes. You're going to have a nice position that you have built over time. And then when it goes in your favor, you will have, again, built a nice position with a nice risk reward. And to my mind, there's nowhere to go but lower in this pair. And if you did get stopped out above the 122 and lost $100 of your $5,000 account, it would be well worth the risk versus the potential reward. So this is just to give you an idea of how I build a position using the long-term trends in certain currency pairs. So I hope you got a ton of value by this little video, and I wish you a healthy and prosperous trading week, and I'll see you next time.